Welcome, everybody. I'm Margie Meisonet, and glad to welcome you back for those who've been with us earlier today for HUD's Partners in Housing training. This session is Lesson 3, Tools for Preservation of FHA-Insured Properties. But before we get to that, I'd like my co-facilitator to introduce herself.
Hi, I'm Gates Dunaway with Tapestry Development Group.
Okay, and let's rock and roll, because this is probably one of our meatiest sessions that we'll have between today and tomorrow, so we have a lot of ground to cover. Okay, as we've done with the other lessons, first we're going to talk about our objectives. The first one for this lesson is to analyze the risks and benefits of recapitalization associated with the Section 236 decoupling process. We're also going to explore the benefits and possibility of deferring the repayment of flexible subsidy loans and the process for requesting a deferral. Then we're also going to identify ELIHPA and LIHPRHA provisions, and we'll describe what those are shortly, and the issues that make preserving these properties challenging, and also some potential solutions. Our next objective is to summarize the mark-to-market program, including the definition of a qualified nonprofit, sometimes known as a priority purchaser, and the potential benefits of HUD modifying, forgiving, or assigning the mark-to-market secondary debt. And we're also going to analyze the requirements, incentives, and tools associated with converting efficiency units into one-bedroom units. So let's start off with topic 3.1, which is Section 236 decoupling. Section 236 of the National Housing Act of 1968 authorized below-market interest rate insured loans to private builders who agreed to develop affordable units reserved for low-income families and seniors. The program lowered the loan's interest rate to 1%. Now, the difference between the market rate mortgage and the 1% mortgage is called an interest reduction payment, or an IRP. And I will mention now that sometimes folks aren't familiar with how much funding they have left for their IRP, and the best way to find that is in your amortization schedule, because this is a monthly payment that HUD applies. It's unlike a 221D3 below market that we talked about earlier, where that subsidy is funded up front at final endorsement of the property. The IRP gets paid on a monthly basis. So continuing on with our overview for Section 236, the IRP funds were allocated at the time the mortgage was approved, creating a revenue source available to the project for the entire term of the mortgage. Many 236 properties need to be refinanced and rehabilitated, but the IRP and the underlying mortgages reduce the flexibility to transfer or refi the property. And that's mainly because the IRP, we'll talk about this a little bit more, legally was supposed to terminate at prepayment or maturity of the mortgage or some other type of termination. So to fix this, Congress adopted legislation authorizing the continuation of the IRP payments even when the related mortgage is refinanced, known as decoupling. So you're separating the original underlying mortgage from the IRP subsidy. So again, decoupling is when the 236 mortgage is prepaid and refinanced. The IRP assistance is severed from the original mortgage and applied to the new financing. And typically how you see that, even though the payments are done on a monthly basis, when you go to do the preservation transaction, a lot of times you'll just see that remaining balance of the IRP is shown as a source on your sources and uses of funds. It provides an additional source of funds for rehab and preservation of affordable projects without any additional cost to the federal government, because as previously noted, the money was set aside when the project was originally endorsed. The result of decoupling can be a win-win for both owners and the residents of these properties. And I also think it's a win-win for HUD with their goal of preserving affordable housing. So I think everybody wins. All right, going on. Eligibility. Any Section 236 property, including the elderly or family properties, can submit a proposal to HUD. Typically, the IRP decoupling proposal is submitted concurrently with a request to prepay the Section 236 mortgage, because obviously you want to continue using the IRP subsidy. So any mortgagee may qualify if a public agency agrees to monitor the use agreement, because the mortgagee is going to continue to receive that IRP, or the new mortgagee. If no public agency will monitor the use agreement, then they must use FHA insurance from a HUD-approved lender, and HUD will continue to monitor the use agreement. And sometimes, when we were doing these sessions out in the field, there were, I think a couple folks had mentioned that they're working with their state HFAs on these, excuse me. And then finally, the term and amount for the remainder of the IRP schedule. I mean, that's how much you have funding, obviously, how much funding you have left. However, owners can choose to reduce the annual subsidy and extend the IRP schedule. So let's say you have, 6 years left of the IRP. If you want to get the payments spread out over 12 years, you can cut it in half, although that's not typically done. There is some additional paperwork that goes along with that. Folks tend to use it just for the remaining period from what we've seen. So subject to mortgagee and HUD approval, the owner may elect to reduce the monthly and annual payments and extend the term, which is what we just said. The owner can prepay the mortgage, process a decoupling, and continue to receive the IRP payments, resulting in a major cash flow benefit to the project. For an example, the owner can refinance and reduce the existing debt service costs while continuing to receive the IRP. In no event will the remaining IRP subsidy be paid out as a lump sum. So when you look at decoupling the rents on a Section 236 decoupling, on the Section 8 assisted units, the budget-based rents are allowed to cover operating costs along with the new debt service figure. Rents are capped at comparable market rents less the IRP subsidy. And the unassisted units, rent increases for the tenants may not exceed 10% without an appeal to HUD. So HUD would need to approve that. For distributions, annual distributions range from 6% to your senior, your elderly buildings, to 10% on family properties of the new equity amount from the low-income housing tax credit or other owner sources.
I'm going to clarify, that's owner sources of equity.
Thank you. Now, use agreement on Section 236, and I also want to mention that if you go to, probably the easiest way to find it is if you Google it, but HUD does have in HUD Clips different forms of use agreements, and they do vary by property type and subsidy type. So you may, if you're not familiar with one, you might want to pull one up there and check it out. Because if you have one on one type of property, it might not match what you would have on a 236. But the basic essence of the use agreement is that it's got to maintain the 236 occupancy and income restrictions, because obviously the goal is to preserve it as affordable. So tenants must earn less than 80% of the median income and pay affordable rents until at least 5 years after the original maturity date of the mortgage. So in return to allowing the IRP to continue, HUD wants to see another 5 years of affordability on the property. There can't be any involuntary displacement of residents. If the owner retains project-based Section 8, and the Section 8 stays in place for the balance of the use agreement. If the owner opts out of Section 8, tenants are eligible for enhanced vouchers. And of course, the owner might opt to renew the contract longer than the term of the use agreement. So in our last session, we talked about tenant protection vouchers, TPVs, for 236 decoupling transactions. Specifically, we want to mention in cases where HUD prepayment permission is not required, HUD will issue TPVs to those qualified residents residing in the non-Section 8 units. And that, generally speaking, you always have to look at your business agreements. That's generally speaking for your profit-motivated owners, where HUD prepayment permission is not required, because your nonprofit owners are generally going to have a requirement to maintain it as affordable anyway. And you can see in the second bullet, it says not available to nonprofit-owned 236s, and not available unless you prepay. So that's another important item that we've mentioned more than once today. If you allow the mortgage to mature, the tenants will not get the tenant protection vouchers. And of course, there wouldn't be any IRP to continue anyway. All right, so that brings us to our first case study, which I'm going to turn over to Gates, and then I'm going to try to handle her tough questions. I know she's going to ask me.
You tough questions. All right, so we have the case study is in front of you. We're going to linger on each slide so you can make sure you absorb it. This case study is a project. It's a 150-unit apartment complex located in a city in New England. The owner is a for-profit developer that built the property and placed it in service in '77 under the 236 program. The question that we're going to try to solve is how can decoupling benefit this owner? So for-profit owner, 150 units in a New England city, and it's a 236 loan.
Is it Boston?
I don't know what city it's in. The case study details. The mortgage matures in 2017. The original mortgage was $3,750,000, and at the end of 2011, there was an outstanding balance due of $1,350,000. The value of that IRP subsidy, if you were to sever it from the 236 loan, would be $912,000. And the capital needs are estimated to be at least $35,000 per unit. Some more details here. This is, there's a Section 8 contract that runs coterminous with the mortgage, and it covers 100 of the 150 units. The remaining 50 units are regulated under the HUD 236 program. And then as shown in a table I'm getting ready to flip to, the current rents at the property are less than the low-income housing tax credit maximum rents, and they are also less than the area market rent. So here's a slide that tells you in this case study what the rents are. The current rents are in the far left corner, left column. $550 for a one-bedroom, $725 for a two, and $825 for a three. The market rent, as we presume as determined by a rent comparability study, is slightly higher in each category, so $600 for a one, $800 for a two, and $950 for a three. And then if this was a tax credit property, which we'll go ahead and tell you that this is meant to throw you off a little bit because this is not going to have a tax credit element. This is the maximum amount of rent you could charge under the tax credit program, which would be $985 for a one bedroom, and $1108 for a two, and $1231 for a three. And then if you note at the bottom, 10% of the residents of the property have incomes that are actually over 60% of the AMI, area median income, and that all utilities are paid by the owner and currently run over cost over $2,100 per unit per year. So that is the rent profile. This first example one shows you basically what this would look like if you were to decouple and utilize your IRP subsidy. So we'll try to walk you through it. This loan, this is the new loan, and that's being described at the top left corner. This new loan that we will get will have a 4.5% interest rate. It's going to be a 221D4 loan. It's going to have a 40-year term and amortization period, and it's going to have a minimum debt coverage ratio of 1.15, and that's going to set the size of the loan. Again, this could be more detailed than you need to analyze this case study, but it's good to understand it. The second point is that we are going to use the IRP decoupling in this example one. The rents are going to increase to market. So we're going to use something that we're actually going to talk about tomorrow, which is marking up to market. So we can presume, as with the slide prior, that we're going to move these rents up from $550 to $6 for the ones, from $725 to $8 for the twos, and from $825 to $950 on the threes. And that would be through marking up under one of two options under the Section 8 renewal guide. And then we're going to get enhanced vouchers for the non-Section 8 units. And this is presumably because we're going to ask permission to prepay, I think.
That's correct.
Okay. So if you look at this is sources and uses for example one using the IRP. And this is hypothetical, but the equity that would be shown in the first line is generally about 5% of the loan. In this case, just over $300,000. There was a first mortgage that was calculated through a lot of background math at over $6 million. And then there's the IRP, which is just under the $912,000 mentioned on a prior slide. That gives you over $7 million of sources. And then we have the uses in the next section. We have the acquisition, which is really just the loan payoff. As we said in a prior slide, there's $1.35 million owed on the 236 loan. That's going to get paid off. And I'm going to skip construction for a second. The rest of those costs, architectural services, financing, legal, and carrying, those are generally all calculated by the loan size and are fairly automatic to the development of the uses. And what it leaves you with is the available sources left over to do construction. And in this case, it leaves us with a construction budget of $5.3 million, which is just over $35,000 a unit. And our sources and our uses match, 7.3, 7.3. In our second example, it's basically the exact same scenario. However, we've not decoupled. We've not kept the IRP subsidy, or the IRP subsidy from the 236 loan. So holding all things constant except for that, you basically can drop straight down to the sources and see that the IRP is zero. And so instead of having $7.3 million, you have $6.4 million to play with. And as a result, if you drop down, your construction amount of money for construction has dropped from $5.3 million down to $4.4, and in this case it's $29,000 a unit, just over $29,000. So those are our two scenarios. And then let's look at our questions for this. So Margie, what are the advantages of undertaking the decoupling?
Well, the most obvious one is that you have $900,000 available for your construction budget. I mean, that's the biggie, and, you know, either way, maybe jumping ahead here, but you can also get the enhanced vouchers for the 50 units that don't have Section 8. But, you know, that's the easy one. The easy one is the additional money to do repairs.
Right, so it begs the question, what's the trade-off? Why in the world would you leave $900,000 on the table?
Well, the biggest one that we heard from folks out when we were doing the training in the field is that you're going to have additional monitoring from HUD. You're going to have the use agreement. You're going to have additional compliance requirements that you might otherwise not have. Now, for this specific example, in the second one that we used, you know, we didn't decouple, but we also went with the 221D4. Think if somebody went with a conventional mortgage, then you have even fewer restrictions.
Even fewer restrictions.
Those were the main trade-offs that folks found.
Yeah, and not to overemphasize, but the extension of your use agreement has been a complaint of folks that might be a reason to leave $900,000 on the table. And the last question on this slide is, what risks will the owner be taking on by doing the decoupling?
I think that one of the biggest ones that we kept hearing was you know, it takes time to process it. And particularly if you're going to do a tax credit deal and you've got deadlines to meet, that tends to be the bigger one. And that's also, you know, and then going back to the trade-offs again, you know, folks might feel risk there with increased monitoring, but deadlines is a biggie.
Okay. What are the advantages of pursuing the conventional financing option? And by conventional, I will clarify, it would be the second option if we were to reimagine the 221D4 as a conventional loan. The lack of the use agreement. Yeah,
I mean,
the
that's
lack of
biggie.
extension of the use
I
agreement.
mean,
which
you
we
still have
already
your Section 8 contract and affordability there, but that's the main one.
And the last question is, would it make a difference in deciding how to proceed if the mortgage was to mature in 2015 instead of in 2017?
Yeah, I think the biggest one, we said there's about $911,000 left, so roughly a little bit over $200,000 a year, so that would be about $400,000 plus not available, or that would have been eaten up if you decide to pursue it, if it were to mature earlier rather than later.
Yeah, and we've seen that situation before when you're down to, like, especially if you're down to 2 years or less, the actual amount of the value of the IRP is so low, relatively so low, that it might not be worth the additional use restriction period and the time and trouble with that.
Okay, thank you, Gates. So topic 3.2, flexible subsidy loan deferral. That's our next topic. And there are a few events that require flex sub loan repayment. Now, I want to mention that this module only applies to the operating assistance program. Gates earlier mentioned there were two components to flex sub, operating assistance and capital improvement loan. We're only today talking about operating assistance because those are the only ones that could be deferred statutorily. So many HUD projects, including Section 202 and 236 properties, also have secondary loans called flexible subsidy. The flexible subsidy loan must be repaid when one of the following occurs. Either the mortgage gets prepaid, it expires, the mortgage insurance is terminated, or upon sale of the project. The repayment requirement can cause difficulty when an owner is putting together an application to prepay and refinance a loan. The cost of paying off the full flex sub loan and accrued interest adds cost to the transaction because these operating assistance loans, these are balloon payments, they're not amortizing loans. So what can an owner do? An owner can request repayment deferral of the flex sub loan. All right, so typically this is done in conjunction with a request for prepayment of the primary HUD loan, like the 236 or 202 loan, because that's the event that would trigger that the flex sub loan be repaid. HUD may allow repayment deferral if the owner can demonstrate that recapitalization is necessary and that there are inadequate resources to pay the flex subsidy loan in full. So in other words, you know, if you got the money sitting there, you're not going to get the loan deferred. Capital loans under statute cannot be deferred. So here are some of the rules for deferring flex sub loan repayment and where you can find them. On February 14th of last year, HUD issued Notice H 2011-05, and then HUD recently issued Notice H 2012-04, which extends the last year's notice through March 2013. And again, you can find these on HUD clips. You can Google them and find them, but there's a ton of information in there, including sample documents that I think are very helpful if you're considering asking for deferral. All right. So this notice authorizes owners to receive a waiver from the FHA commissioner to defer repayment of the flex sub loan, because that's who has the authority to grant the waiver. It makes refinancing more affordable because it allows the owner to defer the prepayment of the flex sub loan and instead re-amortize the flex sub loan for the term of the new loan. So pretty beneficial, I think. And then let's look at some of the requirements to qualify for it. You have to have a passing score on a REACT physical inspection. Generally, that's considered 16 above. In some cases, HUD might consider one as approvable if you can demonstrate that by the deferral will help the property come up to a passing score. Compliance with fair housing and civil rights laws, satisfactory management and occupancy review for the prior 3 years. The owner must be in compliance with their audited financial statement filings. The mortgage must have been kept current over the prior 3 years. There can't be any outstanding defaults or violations. The owner must agree to enter into a 20-year extended use agreement. And then you also have to apply all available residual receipts and then any reserve for replacements funds in excess of $1,000 per unit to the flex subsidy loan balance. So once these funds are applied, the remaining balance is what gets re-amortized over the life of the new loan. And then present a case to demonstrate how deferring payment will benefit the project. We go back again to the notice. I think it's actually quite helpful. They actually give you some samples, some examples there that you might be able to apply to your case. So the owner's proposal shall provide the following information: copy of the current year budget, the most recent interim financial statement in the last 3 years of audited financial statements, projections for 10 years post-closing of the flex sub loan that detail trending assumptions and any changes in operations that result in deviations from historical results. And that's an important thing to consider. If all of a sudden you're seeing, a certain figure that's pretty constant for, pick any expense, any line item that you have, and all of a sudden that figure gets much rosier or much worse over the next 10 years, it's important to explain that so HUD can understand the basis for that change. Then a sources and uses statement for the transaction and a pro forma operating statement demonstrating that all funds received in conjunction with the flex repayment event will be used for project purposes. Also, you have to include evidence of the attempts made to secure loans or grants to repay the flex subsidy obligation. For example, you might apply for grants from the Federal Home Loan Bank because keep in mind there's this requirement that you can't have the money available to pay the flex sub loan. A written statement.
I was going to pause and ask you, what might you show? I mean, we've had this question before. What would you show as evidence of attempts to secure loans and grants? And that question has come to us. And one of the things we tell folks is that, as we all know, low-income housing tax credits is often seen as a potential way to refinance and recapitalize your property. And in the particular case that you were not eligible for tax credits or your state does not favor them for your particular type of deal, you would actually want to go through the exercise of compiling some sort of summary report that either shows you attempted to get credits and you did not receive them, or that you've analyzed the program and found out the tax credits wouldn't work for you. The same might be true for the Federal Home Loan Bank's AHP program. You would want to go through and show that it either does not work for your property, or you tried to get the funds and you were not successful. And put that in the package for your deferral.
Oh, very helpful, thank you. All right, you also need to include a written statement agreeing to comply with each of the requirements listed above, description of how the property is providing and will continue to provide needed affordable housing, and any additional information needed to support the deferral request. And finally, the owner will submit the request to the multifamily project manager and the HUD field office. The field office will review and submit a request to HUD headquarters for a waiver of the requirement for the flex subsidy loan to be paid in full at the time of the prepayment. And in no cases, will these loans be forgiven. So at best, you can possibly qualify for deferral. Mm-hmm. So let's go on to a little case study we have on the deferral of flexible subsidy loans. So I'm going to turn it back to Gates.
Okay. So second case study, this is a packed lesson, as we said, so we may go a little faster than you want, but we'll try to, again, pause on each slide. This case study involves an owner of a Section 236 project with an existing flexible subsidy loan and a Section 8 contract. The project is more than 20 years old, it has a relatively high percentage of vacant units, and it needs the following major repairs. Get ready. Appliances. The stoves in several units do not have burners that work. They must be replaced. The roof needs to be replaced. We're going to go a little quickly through these. The flooring is extremely worn and dirty and needs to be replaced. The windows are original and they do not close properly, so they shall be replaced. To obtain funds to pay for the necessary repairs, the property owner wants to prepay this 236 and refinance the mortgage. Upon prepayment or refinancing of the mortgage, HUD requires, of course, the owner to repay that flex subloan. But the refinancing transaction would have to provide enough money to make all of the required repairs, but it does not have enough money to make the repairs and repay that existing flex subloan. So these are details that you don't know the background of, but let's just assume that the new financing cannot afford to pay off the flex subloan. Here's the sources and uses chart for this particular transaction. And what you see at the top is the loan that this property would be sized for this property. So they would qualify for about over $6.5 million of first mortgage debt. We're not concerned with the details behind that debt right now. And of course, we also assume they were not eligible for any other sources such as tax credits or HP grants. And then at the bottom, you see those uses that are needed. So they need to pay off their mortgage, and then they show the flex sub-mortgage that needs to be repaid right there. Then they show the construction. That $3 million is supposed to cover all those things we just listed. And then the rest of the things are items that go along with the transaction. The total uses in this example is almost $8 million, with only $6.5 million of sources. That leaves you with a gap of over $1.2 million, which is shown down at the bottom in red. That's an illustration of the fact that there isn't enough money to pay off the flex subloan.
Not so coincidentally. It's
it's a nice
almost
example.
The same amount.
It's a nice example. So let's look at these questions. What are some of the short-term and long-term challenging characteristics of this property?
Okay, well, obviously, we know we have some immediate repair needs and probably some interim ones that even if they don't need to be repaired today, they might need to be repaired tomorrow.
Mm-hmm. Also, I think it has a high vacancy rate, so it's driving down your income potential. So what are some of the possible external forces that have led to the condition of this property? So this is something new to talk about.
Yeah, obviously we know it's over 20 years old, so that could be one thing. It was the poor cash flow. It could also contribute to it. In one of our sessions, folks were saying, well, maybe you had an owner who wasn't as attentive, or maybe you had poor management at the property. Maybe the property wasn't requesting and receiving rent increases when they needed to. Maybe they got hit. I noticed the leaky roof. Maybe they got hit by that derecho that hit the East Coast a couple weeks ago. Couldn't wait to work that one in, right?
That's right. That's right.
So there could be a variety of factors that led to the condition of the property.
Yeah. And external to the actual property, we might see decline in market rents, and we could also have seen emergence of strong competitors that actually took away clients from this property. Mm-hmm. What options should the owner consider given the challenges that are facing the property?
Well, the obvious one is ask for deferral of the flex subloan, which is why we're talking about this. So that's an easy one. You're also looking at prepaying the mortgage and getting new financing, which should help. I think you also need to consider your options for the existing subsidy, what you have, and tenant protection vouchers. So you got to look at your finances and see what your best opportunities are.
Okay. There are 3 more questions. How will the tenants in this property be affected by the requirement to prepay the flex subloan?
Right. Well, our textbook answer for this originally was that if the owner has to pay off the flex subloan and they might not have all the money to make repairs, which could have an adverse impact on the residents if the repairs don't get made.
If the owner is unable to obtain the flex subloan deferment, what other options should they consider besides running fast away from their property, throwing the keys at someone?
Yeah, that would not be good. I've had that happen. But anyway, or refinance that we've talked about. And while you mentioned tax credits, may not be the end all, but they might also be a possibility. They might want to transfer the property to someone else who can maintain the property and extend the long-term affordability of the property.
But it definitely would be a pickle to be in.
It would be a pickle to be in. I mean, they could look to see also where the rents are in relation to the market, particularly for those Section 8 tenants. And we also talked about 236 tenants who aren't under Section 8 getting the enhanced vouchers for them at the comparable market rent instead of the local payment standard.
Okay. Last question. If you were the property owner, Ms. Margie, and you determined that you could not obtain the flex loan deferment, what would you do?
Cry, no.
Like I said-
This is actually pretty much the same question
Yes,
as
it
bullet
is.
number 2, but we did throw it out there when we were doing the classroom session trainings and got a variety of interesting
Most
answers.
of
but-
which had to do with run away, run away. All right, and then we have.
Oh, well, you know what, let me add one that comes to mind. So if you put together your package and your proposal, you submit it to HUD, and it's not approved, go back and talk to HUD and say, okay, what can I do to improve, as long as it's not some, event that you can't cure, is there something you can do to make your proposal in compliance and eligible for the deferral?
So talk to your HUD office, continue to probe, and basically try not to take no for an answer.
That's right. We have properties to preserve. All right, so here you see the HUD portal, the website, the URL. Gates previously mentioned the easiest way of it for me, you could Google, but if you go to HUD.gov and then go to offices, housing, multifamily, preservation, they have a great website with all these resources on there, including some of the notices that you could either find on HUD clips or just on the preservation page. All right, topic 3.3, preservation issues related to LIHPRHA and ELIHPA. So I will quickly go through LIHPRHA, which is, I'll read it to you in a second here, but it just takes too long to do side by side. All right, LIHPRHA is the Low-Income Housing Preservation and Resident Homeownership Act. And we're also going to talk about ELIHPA. Whoops, which was the Emergency Low-Income Housing Preservation Act. I got a little bit ahead of myself. And there aren't a ton of these properties. We're going to talk about that, but if you're not familiar with how these came to be, what happened, I'll just give you a brief synopsis. In the late 1970s, the issue first began with Section 515 properties, which are loans from by rural housing, by USDA's office. And some of these owners were starting to prepay these affordable mortgages, and they had a right to, it was fine, but then folks got concerned that tenants were going to be protected. So in 1979, Congress restricted prepayment rights. And then, even though owners had a legal right, and then they said in 1980, what have we done? So they appealed the 1979 Act. So this started affecting not only the 515s, but then the 221D3s. And those were eligible, owners were eligible to prepay those mortgages in the 1980s. So to make up for taking away these owners' right to prepay the properties, then Congress started, allowed HUD to provide incentives for people to stay in the programs. All right. And then beyond that, during that time, after ELIHPA which was the emergency legislation, while that was enacted, then owners, still didn't have the right to prepay, so a bunch of them sued and received additional incentives, and then Congress enacted LIHPRHA, which we're going to talk about some of those incentives, and you'll see why the program no longer exists in its existing form. All right. So between 1987 and 96, HUD-assisted properties received preservation funding under LIHPRHA and ELIHPA. This applied only to 236 and D3 below market properties. We're not going to talk about 515s. So how many properties received LIHPRHA or ELIHPA funding? So you'll see that between 1987 and 96, 750 HUD-assisted properties received preservation funding under these programs. How many units were in these 750 properties? So we're talking 90,000 units. So not huge in comparison to HUD's entire portfolio, but a significant number of units were affected. So here are some of the incentives that were provided to owners to get them to preserve the affordability of these properties and not just pay off their mortgages and turn their properties into market properties. Section 8 rental assistance for eligible tenants, increased allowable returns for 8% of equity in LIHPRHA and unlimited in ELIHPA, access to residual receipts, I should say increased access to residual receipts, and capital improvement loans. But in return, there were use agreements that were not greater for they varied by the program type. So for LIHPRHA, the use agreements are for the greater of 50 years or the useful life of the property. Contrasted with ELIHPA, those use agreements expire at the end of the original 40-year subsidized mortgage. Rents for non-Section 8 tenants are regulated to maintain affordability to specific income tiers. And some of these can be kind of confusing, kind of convoluted based on how the property, what the population was at the time, and how many units they had, and how many Section 8 versus non-Section 8. So there are a lot of preservation issues related to these properties. One is the availability of distributions. Another is the availability of relief from tier rents in the event Section 8 is lost in the future. For partial Section 8 properties, the availability of enhanced vouchers if the underlying legacy Beamer or 236 mortgage is prepaid, and the definition of their maximum rents could be an issue. The availability of an equity takeout after refinancing, the imminent expiration of the ELIHPA use agreements, and the need to or the opportunity to prepay the underlying first mortgage in time to get enhanced vouchers for any non-Section 8 tenants, because, of course, again, you got to do it before the mortgage expires. And then significant variety in the deal structure and requirements of different LIHPRHA and ELIHPA properties. And that's one of the things that HUD has acknowledged during these training sessions, that these properties, a lot of them, they look nothing alike. They're very unique, very specific, which makes them a little tougher to come up with solutions for them. But I understand there's more guidance coming out in that regard. All right, so let's see how we're doing. Okay, let's go on to mark-to-market, which is our next topic. And the main thing, I'm going to give an overview of the mark-to-market program, but the main thing we'd like for you to take away for this is the assumption and subordination policy that HUD has when transferring these properties that have gone through mark-to-market to a nonprofit, to a qualified nonprofit purchaser. So I'm not going to spend as much time talking about mark-to-market, but I really want to emphasize the core piece of it that makes it an excellent preservation tool. So an overview, mark-to-market, or M2M, was authorized by the Multifamily Assisted Housing Reform and Affordability Act. One of the goals of M2M was to reduce project-based Section 8 subsidized rents that were greater than the market level in projects with FHA-insured mortgages. Now later, this was also expanded to include HUD-held mortgages and not just insured mortgages. The program authorized, I would say required, HUD to reduce Section 8 rents to market rent levels in these projects. And then HUD restructured the debt on the FHA-insured properties so the projects could operate successfully with the lower Section 8 rents, because obviously you didn't want all of these insured mortgages defaulting. So basically you have a couple different transaction types. You have the Lite transaction, or sometimes known as the rent restructuring. These are projects that remain viable with reduced Section 8 rents without further action by the Office of Multifamily Housing Assistance Restructuring, which is now known as the Office of Affordable Housing Preservation. These were like haircut properties, so the rents were reduced, there was no restructuring of the debt, and so no long-term use agreement was obtained from the owner. All right, the heart of mark-to-market would be the full transactions, also referred to as mortgage restructurings. These were projects that couldn't continue to pay expenses and debt service after the rents were reduced down to market. These properties receive partial or full payments of mortgages from the insurance fund to reduce the size of the first mortgage, so the market rents covered the mortgage and the expenses. Processing for these transactions was substantial and required a 30-year use agreement from the owner to continue to provide affordable housing. Owners also receive increased incentives under the program as well in return for entering into the use agreement. All right, the existing FHA, again, this is on a full transaction. The existing FHA-insured first mortgage is paid off, and a new, generally much smaller mortgage is put in its place. In many cases, the amount of the mortgage payment is not forgiven, but carries an additional debt in either a second or a third mortgage. And the second mortgage has to be what, under statute, could reasonably be expected to be repaid. The additional debt is payable over time or when the project is sold or refinanced. Most projects that needed mark-to-market restructurings have been completed, but HUD continues to do these transactions even today. All right, I am not, let's see, really going to go into these additional mark-to-market considerations. I will say that in some cases, not every property could be restructured. For example, if there's no insured mortgage, but their Section 8 rents are above the market, like a Section 515 property, or if you have an owner that is in non-compliance with the program, they might not be eligible, well, with HUD requirements in general, they might not be eligible for a mark-to-market restructuring. All right. So let's talk about now the purchase of a mark-to-market property by a qualified nonprofit. These are properties that were restructured into mark-to-market, and they have a secondary debt, or they might even have tertiary debt. They might have a second or a third mortgage. Nonprofit organizations may be interested in purchasing these properties in order to preserve their affordability. Now let's get to the good stuff, which is relief from the mark-to-market secondary debt. HUD may modify, forgive, or assign the mark-to-market debt, secondary debt, encumbering a project if the project is required by a tenant organization or a tenant-endorsed community-based nonprofit or public agency. So the property has to be transferred to a qualified nonprofit purchaser. In the regulations, sometimes you'll see this is referred to as a priority purchaser, but it's the same thing. So until recently, the transfer had to be within 3 years of the restructuring. And in fact, let me modify the second bullet a little bit to say it's not so much that the new notice allows for the extension of time frame, that 3-year window, it actually eliminates the 3-year window, so it's even more flexible than it used to be. In the past, HUD would consider waivers, but now that 3-year window is gone. And then the purchaser has to also demonstrate the necessity for recapitalization. Down at the bottom there, you can see that the authority stems from the Morrow from 1997. So benefits of the QNP debt assignment: if you don't have to pay the debt, the cash flow utilized to pay down the mark-to-market debt becomes available to the nonprofit purchasing the project, and the property is assumed by a purchaser with an interest in preserving affordable housing. Now, there are really, for qualified nonprofit characteristics, there are 4 main things that you have to consider. It has to be independent, so not an identity of interest with the existing ownership, tenant endorsed, community-based, and it must be a nonprofit. All right. So the next 4 slides just go into detail, and we had the luxury of a little more time during our classroom sessions to go through every single one of these. Unfortunately, we don't have that time today, but all of this information is in the housing notice that I just mentioned. And I do understand now that there's more interest in doing these transactions with that 3-year window gone, so HUD has been receiving more requests for clarification on this. So you should take, if you're interested in doing this and we want to know whether or not you qualify, then we encourage you to write HUD or call HUD and ask if you actually meet the definition of it. But all of those characteristics, again, are fully explained in the housing notice. Another place to find it, OAP, Office of Affordable Housing Preservation, also has an operating procedure guide available at oap.net, ohap.net. And there's also a lot of information there as well. That's also an excellent resource just for all mark-to-market related information that you might be interested in. So benefits of the mark-to-market purchase. So here's a benefit to the nonprofit purchaser. If they're approved, the second mortgage and any additional debt evidenced by a contingent repayment note and the mortgage restructuring notes, what it should say, will be canceled simultaneously with the cancellation, modification, or assignment of the second mortgage. This makes a transaction less costly and more viable because, again, you're not paying on this debt. The benefit to the low-income residents is that HUD requires the purchaser to accept a 50-year affordable housing use agreement and a 10-year restriction on the sale of the property. And I mentioned previously that all these different use agreements are available on HUD's website, and this one does vary from some of the other ones that we've discussed today. The benefit to the seller in this transaction is that they're no longer responsible for paying the mortgage and the secondary mark-to-market loan, and the seller may receive a share of the proceeds from the sale. And the notice does talk about what are eligible expenses and then what the net sales would be, and that is subject to some negotiation with HUD. All right, so going on to topic 3.5, this is converting efficiency units into bedroom units. So this is the last preservation tool that we'll talk about this afternoon. So why this is important is that many older HUD properties, such as 202s, 236s, or D3s, or some properties with the Section 8 contract but no HUD mortgage, have units that are obsolete. These units are studios or efficiency apartments that are difficult to market. Now, the notice, today we're really focusing on converting efficiencies to one-bedrooms, but the notice allows for other type of unit conversion types, and those are decided by HUD on a case-by-case basis. So let's say you want to convert one-bedrooms to two-bedrooms. It doesn't mean you can't do it, because we're not talking about it today, but you should contact HUD for those types of requests. And what's happening when you have these obsolete units, that the vacancies obviously hurt the cash flow to the project. The relevant HUD notice is H 2011-03, which sets the policies and procedures for converting efficiency units to one-bedroom units for certain types of HUD-assisted and/or insured properties. All right. In general, owners who want to convert efficiency units to one-bedroom units must meet the following requirements. You have to be in compliance with all business agreements. I think that's pretty well understood. Provide evidence of all efforts to market the units proposed for conversion. The average vacancy rate in efficiency units is at least 25% for at least 24 months. So it's got to be really tough to market these units. If the conversion is part of a refinance, the debt service coverage ratio must be 1.1 or greater. And conversion must only involve units of the same subsidy type. So you can't convert a 236 with the Section 8. Additional conversion requirements. Demand in the geographic area for the proposed conversion. So if you're saying now you want to go from 50 efficiencies to 25 one-bedrooms, you have to demonstrate that there is a market for the one-bedroom units. The conversion would not result in an increase in the amount of existing budget authority available to the project. So you're not going to get any additional Section 8 money, for example, if you're going to go to convert to a unit type that has higher Section 8 rents than what you currently have. The conversion must not result in any violation of Section 504 of the Rehabilitation Act of 1973. You have your notification requirements of residents and a certification that there will be no permanent displacements of residents, and of course the consent of the lender is required. All right, so let's do a little activity, if you would. Gates, please.
Yeah, we're going to look at these conversions as an activity. So we're going to look at, we might look at all 4 properties perhaps?
I think we have time.
Okay, we're going to look at each one and we're going to ask the question of would HUD approve the conversion that's being proposed. So the first one is unit conversion activity property A. This property has 80 units. There's 20 efficiencies that do not have Section 8 subsidies, and those units have an average rent of $300 per month, and they have a vacancy rate of 30%. There are 60 units that are one-bedrooms with an average rent of $475 and an average vacancy of 2% vacancy. The owner wishes to convert the 20 efficiency units into one-bedroom apartments, and we can presume they would convert from 20 efficiency units to 10 one-bedroom apartments.
Right. The other assumption we have in these 4 examples that I should have mentioned at the beginning is we're going to assume all of these have been vacant at least 24 months, which is the requirement. Otherwise, we wouldn't be having the conversation.
So the 30% vacancy under the first bullet is for at least 24 months of vacancy. Is that what you mean? Okay.
30% of the units vacant for at least 24 months.
Okay. Yep. So the question is, would this example receive HUD approval? Ms. Margie?
And the answer is yes. It would be eligible for conversion for the reasons you just stated, that the average vacancy is 30%, and I gave the assumption that all of these examples will have 24-month vacancy.
Okay, so just to go back to the actual facts, because it's over 30 or 25% vacant for 24 months, it would receive approval for those conversions for the studio apartments. Is that right? That's what we're talking about.
That's correct.
Okay. Now here's our property B, what we're calling property B. It consists of 120 units. There are 10 efficiencies with Section 8 with rents at $400 a month and a 10% vacancy rate, we can assume for 24 months. Mm-hmm. There are 30 efficiencies that do not have Section 8 with rents at $300 a month and a 35% vacancy rate for over 24 months. Then there are 30 one-bedroom units with Section 8, and they rent for $650. And then there are 50 one-bedroom units without Section 8, and they rent for $500. So those are fairly confusing, but you got it all in front of you there. So the owner wants to convert the 30 efficiencies without Section 8, those that are renting, the 30 efficiencies without Section 8, those are renting for $300 a month, into one-bedroom units without Section without Section 8. So those would be converted to one bedrooms renting at $500 a month. And then he wants to convert 10 efficiencies that have the Section 8, which are renting at $400 a month, into 5 one-bedroom units that have Section 8, and those are renting for $650 a month. Is that right?
That's correct.
I think I got that all right. Okay, so would that receive HUD approval?
Well, in this particular case, the units without Section 8 would be eligible for conversion, but the Section 8 units may not be eligible because the vacancy rates of those units is less than 25%. In this case, we saw only a 10% vacancy rate. I also want to mention that in one of the sessions that we did, somebody thought, well, if there's no Section 8, then you don't need HUD approval. Well, you do if there's a HUD mortgage, because anytime you alter the characteristics of the property, you do require HUD approval, even if you're not affecting the subsidy type of any of the units.
All right, so there's the answer written out there for you. The HUD answer is the units without Section 8 would be eligible for conversion, but the Section 8 units may not be eligible as the vacancy rate of those is less than 25%. So for this one, it was an issue of vacancy rate. Okay, let's go to C. There's 286 units here. There's 149 efficiencies that do not have Section 8, and they rent for $385 a month with a 35% vacancy rate. There are going to be 27 efficiencies that do have Section 8, and they rent at $800 a month, and they have a 5% vacancy rate. There are 81 bedroom units without Section 8 at $515 a month and a 1% vacancy rate. And there are 31 bedroom units with Section 8 at $935 a month, and they have a 5% vacancy rate. Have you got all that?
Yes.
So the owner wishes to convert 88 non-Section 8 efficiencies, if I had a pointer I would use it, into the 44 one-bedroom units. So they wish to convert the 88 units that are efficiency units
into 44.
88 of those into 44. Yeah. So those are renting at $385 a month and renting them turning them to 44 one bedrooms, renting at $515 a month. And then one Section 8 efficiency and one efficiency without Section 8, they want to convert that into a Section 8 one-bedroom unit. So they want to take a non-Section 8 efficiency and combine it with a Section 8 efficiency and create a one-bedroom unit that is a Section 8. So the question is, would this receive approval?
Okay, well, the units without the Section 8 would be eligible for conversion, but converting the one Section 8 plus the one-bedroom Section 8 plus the one non-Section 8 efficiency into a Section 8 one-bedroom unit would not be eligible because the change would require an increase in the Section 8 budget authority. So if you go back to your slide, you can see that the efficiency with the Section 8 rent is $800 and the one-bedroom Section 8 is $935. So if you want to increase the rent, you want to convert it into one bedroom, you'd have to go from $800 to $935 for that unit, and you don't have any increased budget authority. The other problem is that's not listed on here, is that your efficiencies with Section 8 only have a 5% vacancy rate, so that would also be an issue.
Okay.
I threw that in for bonus.
But the first part qualifies because of that 35% vacancy rate.
That's correct.
Okay. So our last property, Property D, has 200 units. There are 50 efficiencies with Section 8, and their rents are at $450. There's a 25% vacancy rate. Then there are 50 other efficiencies without Section 8 with rents at $400 a month with a 35% vacancy. There are 51 bedrooms with Section 8 and rents at $950. And there are 51 bedroom units without Section 8 with rents at $800. The owner wishes to convert 50 Section 8 efficiencies to 25, we're going to say Section 8 one bedrooms that are renting at $950. And then they want to convert 25 non-Section 8 efficiencies to 25 to whatever the half of that is, Section 8 one bedrooms at $800. Would this receive HUD approval?
All right, so the problem with this one is that conversion of the Section 8 rents, again, would not be eligible as the budget authority would need to increase because you want to take 50 studio units. I'm from Chicago, so we don't say efficiencies, we say studios, at $450 per unit. You want to convert, the owner wants to convert them to 25 one-bedroom units. So at $950, yes. So, you would have to reduce the budgets to, the rents to $900 to stay within the existing budget authority.
So the catch is that if you take two efficiencies that income is $900 a month, because it's 450 times 2.
That's right.
But if you were to convert those into a one-bedroom, HUD would be expected to give you $950, which is increase in budget authority for those two. I've
That's
got that.
correct.
Okay.
Yeah, and let me just, if I can, let me pull it up here. All right, so I know we went through those a little quickly just because of the lack of time, but the main thing that I think we want you to take away from this is that there's a ton of information in the housing notice. You have to be mindful of combining subsidy types. You have to be mindful that they have to be vacant for at least 24 months, and that you're talking about vacancies 25% and higher. So those are the main things. So we're sorry we had to go through those kind of quickly, but that's the main gist that we'd like you to get out of that, those exercises. All right, here's the reference again. And again, please keep in mind, we're not just talking, we are today, studios into one bedrooms, but you could also convert different unit types and go to HUD on a case-by-case basis to those. So are these my questions, Skates? I think they are.
I believe so.
Okay, let me get on the right page here. All right, so I'm going to ask you an answer, or you want to ask and I answer?
You ask. I'll see if
Okay.
I can do a good job.
All right, good, that's easier. All right. What is the main benefit to owners of Section 236 properties who are able to accomplish a successful 236 decoupling transaction? Is it A, their release from the responsibility of repaying any subordinate loans against the property?
No.
Well, you don't even wait for me to click to the next, that's great, okay.
There's nothing about that in it.
They're able to reduce debt service costs while continuing to receive the interest reduction payment associated with the original loan.
Maybe.
Oh, yeah, you're sneaky, aren't you? Okay. They are able to receive annual rent increases for the term of the new loan when they refinance the existing loan. In lieu of the interest reduction payment, they are able to execute a new Section 8 contract that provides long-term income stability to the project.
Well, I think the main benefit under the decoupling question is going to be B, which is associated with the receipt of the interest reduction payment, continuing receipt of the interest reduction payment. The C, they are able to receive rent increases for the term of the new loan, doesn't have anything to do with decoupling, although it's possible through a markup to market. And then I don't think D is right at all. So I think it's B.
Well, let's see how you did.
Yeah.
Yes. They're able to reduce the debt service costs while continuing to receive the interest reduction payment associated with the original loan. So yeah, that's the right answer. Next question. What must the owner of a project with a subordinate flex sub loan demonstrate in order for HUD to be able to defer repayment of the flex sub loan? And you may have multiple right answers here. A, there are insufficient resources to pay off the flex sub loan in full. B, increasing tenant rents in the project enough to raise the capital required to repay the flex sub loan would result in a significant reduction in the occupancy rate because everybody would move out. The payments they are currently making on the flex sub loan is the reason they've fallen at least 1 month behind on the existing mortgage note. Or D, the recapitalization that will result from the associated refinancing transaction is necessary to preserve the property.
Well, we didn't talk about C, the payments that they're currently making the flex sub loan is the reason they're falling. That's not even been mentioned. Plus, they probably are making 0 payments because it's an operating assistance grant that was a balloon note.
And the other part of that is, the other reason that's wrong is if you've been delinquent in the last 3 years, you can't qualify.
That's
on your
true, so it's a
existing
catch
mortgage.
there.
Uh-huh.
And then B, increasing tenant rents in the project enough to raise capital required to repay the flex sub loan will result in a significant reduction in the occupancy rate. We didn't speak of that. That makes some sense, but basically, most of these we're talking about increasing Section 8 contracts having nothing to do with the flight risk to the tenants. I believe it's A and D. There are insufficient resources to pay off the flex sub loan in full, and that's why you're asking for deferral. And D, the recapitalization would result in associated refinancing transaction as necessary to preserve the property. Otherwise, you may lose the property or it may diminish and not be a good source of quality affordable housing. What do you know?
Right on the button. All right, well done. All right. So let's review our Lesson 3 objectives that we went over today. We analyzed the risks and benefits of recapitalization associated with the 236 decoupling process. We explored the benefits and possibility of deferring the repayment of flex sub loans. We identified ELIHPA and LIHPRHA provisions and issues that make preserving properties that participating in these programs challenging, and some potential solutions, recognizing, we would obviously love to see more, and we know HUD's working on them. We summarized the mark-to-market program, including the definition of qualified nonprofit and the potential benefits of HUD modifying, forgiving, or assigning the mark-to-market secondary or tertiary debt. We analyzed the requirements, incentives, and tools associated with converting efficiency units into one-bedroom units.
Thank you, Margie. That was great. This concludes Lesson 3. We're going to take a 15-minute break and be back at 3:45 Eastern Time to do Lesson 4, which will go probably only about 30 minutes or so. And this is the lesson on 202 loans. If you're going to tune out that lesson because you don't have a 202 loan, then let me tell you about tomorrow again. You can join us at noon tomorrow, Eastern Time, and we're going to have a Lesson 5, which is where Margie's going to talk to us about HAP contracts. And then after a break, we're going to come back at 1:15 tomorrow, and that we'll have Lesson 6, which is about FHA refinancing strategies. And then our last lesson, Lesson 7, will start up at 2:30 tomorrow, and that'll be a very light lesson on tax credits and how they may help you. Thanks.
Thank you.